Small caps get a lot of attention. Large caps obviously get a lot of attention, but we're here to shine a light on the more exciting part of the market.
The undiscovered gem
of the
Aussie equity market, we like to call it.
The ASX 50 is dominated by banks and miners. As we go down into the mid-cap world, how different is the mix?
When you come over to the mid-cap part of the market, it's a lot more diversified from a sector and style perspective. Looking at the returns of the top 50 over the last 5 years, over 50% of that has come from financials. Whereas you come over to the mid-cap part of the market and there hasn't been a single stock over the last 5 years that's driven more than 8% of the returns.
There's a lot to like about the mid-cap opportunity set. So I'd love to drill down on your process and really understand how you identify the opportunities that are worth researching further.
Yep.
Investors love small caps. There is a real joy in finding small companies not yet discovered by the market full of unrealized potential. Investors can dream of finding companies that can do 10x or 100x returns, the next Pro Medicus, the next REA Group, the next Fortescue. What undiscovered gems are waiting to be found? But small cap managers have a disadvantage. They do all the work, find the great names, and then are forced to sell right as the company hits its straps and gets into its growth phase. That insight is why today's guest believes we should spend more time looking at mid-caps. From Equity Mates Media, this is Basis Points, a show that helps advisors find small improvements that can compound into big outcomes. I'm Ren, and today I'm unpacking why mid-caps offer investors graduates, not gambles. To do that, I'm joined by Jovana Gagic, a portfolio manager and analyst at Paradice Investment Management. In this conversation, we're going to unpack the dominance of banks and miners at the top of the Aussie market and how the mid-cap index looks different, how we can identify these great small caps that are poised to break into fast-growing mid-caps and beyond, and some of Jovana's largest positions in her fund. Now, before we get into it, a massive thank you to our launch partners, SIBO, Milford, and Orbis Investments. But for this episode, a particular thanks to SIBO. Did you know that Australia has more than one stock exchange? You might have traded on SIBO without even realizing it. With approximately 40% of all Australian ETF trading happening on SIBO, they understand the growing interest in ETFs among Australian investors. A massive thank you to SIBO for sponsoring this episode. Finally, a reminder that all episodes of Basis Points are accredited by the FAAA for CPD points. So if you're an advisor watching or listening, head to the link in the YouTube description or show notes, complete the quiz, and we'll send you a certificate. All right, well, with that said, let's get to my conversation with Jovana Gagic. Well, Jovana, welcome to Basis Points.
Thanks for having me.
So I'm excited for this one. Mid caps. We haven't spoken. Small caps get a lot of attention. Large caps obviously get a lot of attention. But we're here to shine a light on, well, at least I'm sure you would say the more exciting part of the market.
The undiscovered gem
of the
Aussie equity market, we like to call it.
I when I was prepping, I labelled it graduates, not gambles.
Okay, I like that. I'm going to take that one. Yeah. A trademark.
So I want to start with the simple insight that kind of led to the mid-cap strategy years ago before it was an active ETF, which was that the best small caps graduate out of the index.
Yeah.
Can you illustrate that with an example and sort of shine a light on what some small cap managers or investors might be missing out on?
The majority of small caps, so the majority of mid caps, I should say, were actually once small caps. So we saw that that was sort of the genesis of why start a mid-cap product. So you could see all these really great companies maturing, and then, you know, being a small cap manager, you kind of have to sell it after a certain period. And there's plenty of examples throughout the history of the fund. Like Cochlear is a great example, was once a small cap, owned it in the fund in those days, wrote it through the mid-caps, and then sold it when it became a large cap. And one just more recently would be like a Life 360, which, you know, was a small cap darling for a long time. When they introduced advertising, which was expected to significantly increase their revenue, it actually went from a small cap to a mid cap. So you hit this inflection point, and then small cappers have to say sayonara to a really, really good company. So yeah.
And just to get some definitions out of the way, in your context in Australia, what do you define as a mid cap?
Yeah, so it's ASX Midcap 50 index. So it's stocks that sit 51 to 100. So you've got the top 50, and as you would know, that's pretty much dominated by the banks and the big iron ore producers. And so 51 to 100 is our kind of definition of a mid-cap. And then you've got the small ords, which is 101 to 300.
So 51 to 100, not a massive pool for you to be fishing from.
No. So our fund is actually X50. So it's the mid-cap index plus smalls. So we do invest in small caps. And the reason for that is going back to your previous question, it's you want to identify these companies when they are small caps and then take advantage of that inflection point as well. So 80% of our portfolio does sit within that mid-cap part of the market, but then we do selectively pick the best performing small caps that we see have that long-term structural growth story in them.
Now, you identified the issue that small caps graduate into mid caps and small cap managers have to sell.
Yep.
Do you not have the same problem that mid caps graduate into large caps?
You do, but generally when you go from a mid cap to a large cap, you're mature, you don't have that same level of growth. So you can see it in the earnings growth. Like if you look at the top 50 over time, they sort of give you, over the last 5 to 10 years, it's sort of GDP style, 3% earnings growth, whereas mid caps, you get that sort of 7 to 8% earnings growth. So it's kind of a different point of the life cycle when you go into large caps. So it's not that same level of growth that you see.
So if you think about like company growth as an S-curve, it's about getting the right point of the S-curve.
Yeah. You want to get them when they're small caps, but they're not concept stocks. So we don't invest in concept stocks. You want established businesses, well capitalized, and they're really, hitting their straps and they're seeing that sort of exponential growth coming through.
Yeah. I mean, it makes sense.
Yeah.
So you said that part of your job is to look at the small cap world and try and identify some that are poised to grow into, high growth mid caps.
Yep.
Any particular companies or particular sectors that you're excited about at the moment?
Yeah. So Regis Healthcare is a small cap that we like and we own in the fund. And just for background, aged care operator. The government's finally woken up to the fact that we've got an ageing population and we have an undersupply of beds. And so what they've done in recent years is they've actually reformed the whole system and they've increased funding to the sector. And what's great for Regis is they're one of the biggest players in the market, but they're also still quite small. So market share for them is in the single digits. And so there's an opportunity to not only consolidate and grow through that angle, but also organically with this government revenue coming through to really kind of see that earnings growth come through over the next couple of years.
Yeah, nice. Big structural tailwind.
Yeah.
So this strategy's been run for almost 20 years, I believe, as a unlisted fund, the Paradice Australian Midcap Fund.
Yep.
But you've recently made the decision to list it on SIBO as an active ETF. M1DS is the ticker. So I guess take us back to the unlisted fund's history. Has that original insight translated into a track record?
Yes. So the mid-cap part of the market, we wouldn't be around for 19 years
I was going to say,
if the thesis hadn't have worked. But the mid-cap part of the market is the fastest and highest growing part of the Aussie equity market. So if you look at the last 15 years for our funds returned about 10.7-ish% versus the ASX 200 at 8.8%, and then small ords sitting at around 5% over that 15-year period. So you can see that mid-cap kind of growth really showing through for investors over time. So it's good to see. Yeah,
it is good to see. And now taking the step to list it as an active ETF, what was the thinking there and how's it been so far?
Yeah, so historically, Paradice has been very much institutional focused. So a few of the big super funds have been the big backers of Paradice. And we've made a concerted push into retail over the last couple of years. So listing on SIBO came about just to provide an extra access point to investors in the retail wholesale market to just get access to the product. So you can actually get it in an unlisted form, but with the way active ETF growth is growing, it just provides another access point. So same fund, same way we've always managed it, but just to...
Yeah, and I mean the great news for all the advisors listening is they can now access it on the wrap platforms like a lot of other funds and a lot of other stocks these days.
Yeah, definitely.
Yeah. So I want to talk about diversification because you mentioned earlier that the ASX 50 is dominated by banks and miners. That's the common lament about the top of the ASX. As we go down into the mid-cap world, how different is the mix?
Just to shine a light on that top 50 as a starting point, 40% of the top 50 is financials. So a lot of that is your blue chip big banks, and then 20% of it is materials, so which is the big iron ore producers. So you've got 60% of the top 50 that sits with two themes really. Whereas when you come over to the mid-cap part of the market, it's a lot more diversified from a sector and style perspective. So if I pick on resources as an example, that's less than 20% of our index. But even within that, you've got a broad mix of commodities that drive it. So you've got gold, you've got the hottest thing in town right now, rare earths, lithium. So it is a lot more diversified from that perspective. And then if you were to look at how that translates from a returns perspective, looking at the returns of the top 50 over the last 5 years, over 50% of that has come from financials. And if you were to double click on the last 12 months, CBA alone has driven a quarter of the top 50 return.
Yeah, right, okay.
Yeah, so it's been quite huge, and a lot of that has been re-rate and not really the earnings growth coming through. Whereas you come over to the mid-cap part of the market and there hasn't been a single stock over the last 5 years that's driven more than 8% of the returns.
Yeah, wow.
And fun fact for you, the biggest has actually been WiseTech. So in the mid-cap index, it was about 7% of the returns over a 5-year period.
Wow. I mean, I guess WiseTech is a really good thesis validator for the mid-cap story. It's like you ride it all the way up and then you sell it as it gets into the top 50, and then that's when all the problems start.
Yeah, that's when all the indiscretions, all the houses.
Yeah. Which we're not going to double click on that story.
Moving right along.
Yeah. So I had a look at your top 10 in preparation for this interview, and I think it really validates what you were saying there around the diversity. I think Orica, Charter Hall, and Life 360, you're not going to get three sort of more different businesses that have different structural tailwinds and headwinds and drivers and the like. When you think about building a portfolio out of a more diverse range of options, what are some of the commonalities that you're looking for? And specifically for those three, what are the commonalities that bring those three together? Yeah,
so you're right in saying there's not a lot in common with those three stocks, and that is on purpose. So it kind of goes back to the philosophy of the fund. So we're we're style agnostic, sector, value, growth. We'll invest in everything, and it really does shine through in our top holdings. That's a great example. We're very bottom-up fundamental investors. So if I pick on Orica for the reason why we own it, so that's one of those stocks that was actually in the top 50, bit of a fallen angel, fell into mid-caps, had some internal issues, and it's gone through this turnaround with this new CEO coming in, and really a change in strategy to focus more on value add and technology, driving better margins, and they've repriced a lot of their contracts, so they're getting better. They're not doing unprofitable business anymore, so that naturally boosts your margins, and a stronger focus on return on invested capital. So you've got a better management team kind of leading a new strategy. So we like that one. Charter Hall, property fund manager. So question marks around where interest rates go from here, but stable to maybe cuts a bit further out. But what we do like about Charter Hall is after a few years of subdued growth, you can see that the fund inflows are starting to come. So investors are looking to deploy back into property. Plus you do have cap rates potentially coming down over the next couple of years. So that also provides a nice tailwind. And they're also a market leader in the space. So they are well positioned to take advantage of the trends as they come through. And then Life 360 as well, so a tech name. So you've got an industrial, a property fund manager, and a tech name that sit within our top holdings. So the location tracking sharing platform, they've got 88 million monthly active users. And what we're seeing there is we're seeing really strong conversion of that free user base into paid users. So they're seeing strong subscription revenue growth, and then advertising we touched on. So they've launched that as well. That'll be a big driver over the next 3 to 5 years. So you can see from there it's very, very stock specific reasons. So we buy these companies we take a bottom up view on them. We think they can outperform the broader market, and that's sort of the genesis of why we own them.
Yeah. I mean, even as you were explaining that, it's like even not just industry or themes, but it was also like characteristics, I get, or like stage, like Life 360, obviously in this fast growth phase, Orica turnaround.
Yeah.
How much are you thinking about diversifying like company life cycle stage as well? Like turnaround versus high growth.
It's sort of an outcome.
Yeah,
we don't try to make sure we've got a balance. Like we monitor sort of within a risk management framework. We'll monitor like different factor bets in the portfolio to make sure we're not taking unintended sort of sector or style risk within the portfolio. But everything we do is sort of from that bottom up basis.
How cyclical is this part of the market compared to large caps? Is there a particular point in the cycle where they really start to shine?
Yeah, so often because they do have that structural growth tailwind behind them, the macro is less important. So unlike smalls, which you need really strong funding environment to kind of see the growth, but with mid caps, they're pretty well capitalized. They've got a really strong revenue stream, cash flow coming through, so they can self-fund their growth. And then the mature businesses, as I mentioned, they sort of grow at that GDP style. They are maybe a little bit more skewed to the macro, but within mid caps, you've got all these other tailwinds that are driving the performance. So the macro, whilst is a consideration, it's not the be all and end all. And in fact, I think about Reece during the GFC, they rolled out more stores during the GFC than throughout the history of the entire business. So when you do have that, when you are well capitalised, it does actually provide you with an opportunity to actually just accelerate the growth. And when you come out the other side, you're actually better placed than when you went in. So, yeah.
So I guess at this stage, like there's a lot to like about the mid-cap opportunity set, less cyclical, faster growing, ticking a lot of boxes. So I'd love to drill down on your process and really understand how you identify the opportunities that are worth researching further.
Yep.
Are there any sort of particular data points or signals that or I guess like green flags that you're looking for as that company is graduating from the small cap index that you think, all right, that's something I'm going to look into further?
So a big part of what we do, we're very big on seeing companies and getting out on the road, very old school approach. We do a lot of travel. I was just in the US in September with one of my colleagues, Jordan, and Matt's just got back from China. So we travel quite a bit. We see companies a lot. And what we really look for, and we're seeing small caps as they're coming through. So we do follow the journey, but the point where we will invest is where we can actually see, well, as a starting point, we need to see revenue and profitability or a path to profitability. So we don't invest in concept stocks, but we're looking for a really strong moat or structural advantage or an industry that's small and growing, or there's been a change in the industry structure. Like Regis, for example, the government revenue model has been completely changed, and then that's provided an opportunity to invest in a company. So we are sort of looking, it varies on a stock by stock basis, but holistically, I would say we're looking for structural growth stories. But, like I said, with Orica, we also don't mind a turnaround where, we can see that the market has got it wrong and it is actually the strategy that they've adopted is actually working.
Yeah, okay. Any insights from your recent US trip? Anything big that stood out for you over there?
I think the AI piece was probably the one which is funny. It's so topical. Are we in a bubble? Are we not in a bubble?
Do you have an answer to that?
No. If I did, I wouldn't be sitting here. But no, with the AI piece, for us, it was what you could see is it was turning from a training to an inference piece. So we spoke to a lot of companies, and the monetization and how it gets monetized, there's question marks around that. But the adoption and the productivity gains that are coming through for companies, like that was one thing that we focused on and was highlighted to us, and just seeing that kind of the real life examples, I guess, coming through. And then on the consumer piece as well, we came away not as concerned on the consumer in the US, which is controversial. Yeah. We did a retail conference in New York, and it was, it's not sunshine and rainbows and it's not all flying, but it wasn't dire and as grim, and they were managing through tariffs better than what we thought prior to the trip. So, yeah.
Okay, that's reassuring because you certainly some of the stories you certainly hear. It doesn't seem great. And,
yeah, I think you can read the headlines and the economic data kind of whips around, but importantly, when you get out and get on the road and actually go over there and speak to these companies, I think you can piece together the macro through the micro just by talking to companies.
Yeah. So I guess I asked earlier about green flags. I'd love to flip it around and ask about red flags. I'm sure there's plenty of companies that graduate out that might look exciting for investors and they might be capturing financial media headlines. But are there any red flags that you're looking out for at that point?
Yes, I mentioned we see companies a lot. So what we're looking for from a red flag perspective is there a change in the thesis, or is there a change in the narrative? Is there a new competitor coming through? And I'll give you an example.
Yeah,
IDP education is a good one. So English language testing and student placements. So migration trends are key for them. And in a pre-COVID world, that was all good. Every country around the world was happy to take migrants. And then just more recently, we've gone through this global anti-migration trend. And because IDP had been such a market darling and constantly was delivering, the market had been slow to react and recognise that this was not a short-term shift. So what typically happens with market darlings is consensus numbers will correct for the next six months, and then there's always this rebound that comes through. So just picking up on when there is actually a change in the story and the narrative has shifted, and IDP went through multiple downgrades because the market just wouldn't understand that it was more than just a 6 months blip. Like there was a global trend in all the countries that they were operating in that was actually experiencing the same thing at the same time. So we do look for, management changes are a reason to go and see what's happened, chat to the company. Has there been a change in the reason why we own it? And we're not afraid of cutting positions, and if we've lost money on it, we're happy to cut early rather than hold on hoping for things to turn around, because often things take longer to turn around, if at all.
Yeah, nice. Jovana, I'm going to take a quick break here to say a massive thank you to Cboe. Here's something you may not know. Australia actually has more than one stock exchange. And if you've ever bought an ETF, there's a good chance you've already traded on Cboe Australia without even realizing it. In fact, around 40% of all ETF trading in Australia happens on Cboe. It's clear they're right in step with the growing interest in ETFs among Aussie investors. So, next time you're investing, keep an eye out. You might be trading on Cboe again. A massive thank you to Cboe for sponsoring this episode of Basis Points and helping us keep all of our content free. Is there a company in the portfolio now that really represents that graduation moment where it was maybe like a concept or a bit more speculative in the small cap world, and then like something changed, something clicked, and it graduated into that reliable mid cap?
Yep. So this one's not a mid cap yet, but it is potentially going into the mid cap index at the next rebalance, and that's Zip.
Okay,
So buy now, pay later actually was born in Australia with Afterpay, but now they've gone over to the US. Actually, when we were in the US, we saw a firm on 3 separate occasions just to get an understanding of that buy now, pay later space and the growth coming through, because they're slower than us with the buy now, pay later adoption. But at one point during that 2021 period, like Zip was a micro cap, like it almost went broke. Did well in a zero rate environment, but then as rates normalised, the business concept was kind of flawed. But what they did during that tough period was they brought in a new CEO, Cynthia. She's excellent. Really, really rate her very highly. And what she did was really recognise that, okay, we needed to turn the ship around. We needed to sell and get out of all these unprofitable geographies and really focus on the biggest market, which is the US, but then also keep Australia because it is quite profitable and more mature for them. So that's a company where it's been a volatile ride, but the growth in the US is really, really strong. Transaction volumes are growing over 40% at the moment. So that adoption piece is really coming through in the US as an alternative to credit cards. But yeah, it's gone from a small cap to a micro cap to a small cap, and then now it's potentially going into mid caps. So
yeah, the Zip story is just, it's a phenomenal story.
Yeah.
Because obviously, you know, Equity Mates, the main podcast we do, is very much retail focused. And so you can imagine the Zip conversation in sort of 2021.
yeah.
And then it fell 98%. And
Wow.
Yeah, now it's 10 bags on the
Yeah.
way back up. It's just it's incredible that they stuck with it and they turned it around.
Yeah, I think you got to give credit where credit's due. I think the management team really did a good job just recognizing where they were at and what they needed to do, and implementing, you know, better controls around bad debts and getting out and just really focusing on what matters, and like the US is really key to the success of the business.
So let's stick on management for a second, because I imagine that's such an important part of, well, it's an important part of any investor's process, but particularly in the mid-cap space when many of these companies, I guess, are trying to build the plane as they fly it as well, and they're trying to scale and grow as, you know, they're growing the team and everything at the same time. What are like the hallmarks of a great manager at that stage of a business's life cycle?
So I think recognizing that there's a team behind them that needs to do it, so you can't have a one-man band. So generally meeting multiple layers of management. Investor days are really good for that, in catching up with different people in the management team, but also just sitting down with the CEO and just trying to understand what the strategy is, where they're going, does it make sense, and are their incentives aligned?
Yeah,
That's a big piece, and it's one of those things that everyone always talks about, but it's like common sense. It's almost like common sense. And yeah, just making sure that, are they aligned to the outcomes, because incentives at the end of the day do drive outcomes.
I mean, talking about CEO incentives being aligned, I have to ask you about Drone Shield. Like, if one of your portfolio companies, their CEO dumped all of their stock, what would you do?
I'd be very angry. It would, be a bit of cursing.
I imagine that fits maybe the red flag.
That's definitely a red flag. Insider selling, when it's a little bit to pay tax or whatever, that's fine. But when you go and dump all your stock right after it vests, I've got some question marks, and that would definitely be a cause for concern, and possibly a sell. In Drone Shield example, probably a sell.
So, I mean, that Drone Shield example is probably a good one to segue to where I wanted to go, which was the risk management side of it. Because these structural growth stories, we've seen some incredible stories in Australia, but we've also seen where narratives turn and then they can blow up. What's your approach to risk management in this space, and how are you sort of avoiding the big blow-ups?
So our portfolio is not very concentrated, so we are quite diversified. Like our active shares, the sweet spot for us is sort of that 55%. So what we tend to see is mid caps as an asset class gives you growth over and above the broader market. So we want to make sure that investors actually capture that growth, and then if we can do 3-4% over and above that, that's ideal. And the way we sort of look at investing and adding stocks into the portfolio, we'll generally start our position sizing quite small, and then as we gain conviction on or the thesis sort of starts to prove itself out, and we've caught up with management and everything they're saying ticks all the boxes, we'll add to that position. And if there has been a thesis breakdown, we'll happily cut it. And generally, you can avoid kind of the flow-on effect of the continuous downgrades and the share price falls from there.
Yeah, nice.
But I would say that, risk management is a key focus for us. We've got all these risk management screens that we look at internally, looking at factor bets and style tilts and sector exposure, just to make sure that we're managing that as well, so you're not taking on any unintended risk.
I want to close by getting practical with some takeaways for advisors listening.
Yep.
When we're thinking about mid-caps in portfolio construction, where do you see mid-caps fitting? Is it core? Is it satellite? Is it somewhere else?
Yeah, so we see it as a core holding, being the best performing part of the market. I mean, I think that should be a core holding, but also from a risk perspective, if you look at the large caps, you've got greater sector and style exposure, a lot more diversified from that perspective. But also, if you look at it, over the last, if I just focus on like the last 5 years as an example, like COVID drawdown, if I look at smalls versus mids, it was pretty similar. It was an indiscriminate sell-off. But then you come out of the recovery phase in that sort of zero rate environment when, smalls got a lot of attention, probably because there are a lot more small cap managers. Mid caps actually did better kind of out of that recovery, although a lot of stocks, the whole market did really well, but mids actually performed the best. But then the last 3 years you've had various macro events. You've had rates going up, you've had COVID normalisation, you've had Ukraine-Russia war, Trump's come in, and over that period, mid-caps have actually continued their outperformance. So it is a consistently kind of outperforming part of the market.
When you speak to institutions or advisors, are there any common misconceptions you hear about this part of the market?
Yes. So that piece around it being the best performing part of the market is the one thing that through our conversations with advisors has really resonated, and segmenting the market in the way that we do with the top 50 mid caps and small caps, and just showing them that, hey, actually you're missing out on the best performing part of the market by ignoring mid caps.
I do. Some fund managers have a really hard sell. It's like, I'm N+1 Aussie large cap manager or something. But being able to say, well, I represent the best performing part of the market is a good starting point for the conversation, I imagine.
Yeah. It does open the door. People are generally interested.
Yeah. So as we close it out, if an advisor is explaining mid caps to a client, and maybe we have covered some of this already, but I will ask it anyway. What is the simplest way to articulate the opportunity?
So I would say that mid-caps are the strongest returning part of the Aussie equity market compared to large caps and small caps. And within mid-caps, you get the diversification away from banks and resources. So you get the sector and style diversification, and then relative to small caps, mid-caps consistently outperforms and is an index that is made up of the best small caps that have graduated into a mid-cap. So it is a bit of a Darwinistic style of index, if I can call it that.
Yeah. Survival of the fittest.
Yeah, survival of the fittest.
Yeah. Well, Jovana,
undiscovered gems.
Undiscovered gems. Graduates, not gambles.
Yep.
All of these apply. Jovana, thank you for joining us today.
Thank you for having me.